UGFX. What's up, man? All right. I'll go ahead and start it.
Was unfortunate that I couldn't do it today. OBS wouldn't connect to my.
Join TastyFX for award-winning service from a broker who gets why you trade.
Daily chart here. You can see bear shorter block again, working that level a few times more over the last few days. We have a small little fair value gap there, and we traded back down into the old weekly inversion fair value gap. And again, assume for a moment that we move higher. Okay, unless we break below this low here, I'm going to stay with that narrative. And if it does, we'll be looking for buy side here.
So what he's kind of referring to is he most likely was looking at this as a normal fair value gap, but as soon as we went up and disrespected it, it's normally going to be resistance, right? Once we trade up into it, it's going to try to push us down, but once we disrespect it, we could consider that as support. And he talks about how if we're going to remain bullish right here, we don't want price to trade below it, because then that would act that can act like resistance, pushing us lower. So we want to stay above it so it adds support.
And then we have a volume imbalance there, and we have a wick, so consequent encroachment of that. I don't have it on here because I don't want to have too many lines, but I have that level in mind should we go above this high. Midpoint of this wick, and then the volume imbalance. Okay, that's also the premium wick consequent encroachment on the weekly chart. Let's go back up one more time. That's this one.
So that's kind of our topic today. So I guess I'll just lead into that. We're gonna talk about Wicks, discount Wicks, premium Wicks, and how they can be put into our analysis, kind of like a normal PD array would. So let me hop on over here. Let me delete all this. So something I was looking at today is if we notice these wicks right here, so we don't have like too much development right here in terms of PD arrays, but you can come in here and let me look at, actually I think yes looks better. Yeah, I already marked it out. So we don't have much development over here in terms of PD arrays. So what I would do is I would take this wick right here, I would measure it out. We have the 0.75 level, 0.5, 0.25. If we hop down on the lower time frames, you could see like this, the midpoint of that wick, which was the 0.5 area, the consequent encroachment. You can see how well price respects that. And if we're able to combine that with other PD arrays, like right here, that's perfect. Take your short right there. It's just extra confluence to our trades. We could even go as far as to, let me bring that back up, measure out this wick right here. Right, you could see how kind of the 0.5 level, it's respecting it. 0.75, I think it's supposed to be opposite actually, like this. 0.25 right there. So that's kind of how we're using wicks. So that would be a premium wick. Let me see if I have more examples in here. So A discount wick would look like this. So measuring from here to here, you see the 0.25 level. It's respecting that right there. May drop down lower. If you're coming in, please mute yourself. Again, we can use these wicks in here. Discount wicks. Like that. So if we combine that with something like a liquidity sweep right there. Could go along off of that. So discount wicks and premium wicks. You could use them like a fair value gap. Just because you don't get a sweep, sometimes we're just respecting the wick, like right here. Let me see if I have any more examples. Right here. Using our discount wick. Trade down nearly perfectly, touch the CE. If we're looking for some kind of reversal right here, we wait for that retracement into that area, and then we could kind of find a trade up into this. Yeah, it's perfect. So say we see that it hits 0.5 area perfectly. We see us come up, create this order block. That would be our market structure shift. Enter right there. Targeting this high. These stacked highs. That's a really good trade right here.
Here, okay. All right, so let's move down into an hourly chart for dollar index. Usually I don't do this with you, but we'll go into a little bit more detail here. So inside this swing low, all this price action, this is a swing on a larger daily chart, but we're looking at through the lens of an hourly chart. See this gap right here? Notice there's an absence of one over here, but look at all the back and forth price action. So we have only sell side here offered. So that means the candle went through between this candle's low and this candle's high. It delivered on the downside. So it's sell side delivery. Inefficient in the form of buy side delivery. So it's offered here on this candle. Then the next candle, we open, trade down, rally back up, and close right here. Next candle opens, trades down, stops right inside that gap low, then sends it higher. This is a balanced price range. Balanced price ranges tend to either stop at their high or low, or midpoint, or which will be consequent encroachment, midpoint of the gap. We can see that happening essentially here. So this extended through, and again, this is the reason why it's not supply and demand, folks. We cut through candles to get to a narrative. The algorithm's going right back to this inefficiency. And the fact that we traded back and forth here, buy side, sell side, has been offered. It left that range right here. If it ever comes back down into it, it's highly unlikely that we'll trade to the low of this gap again and through it. So that's what makes a ICT balanced price range. We also have a imbalance here. I wanted to make sure I highlighted this gap, but this candle's low and this candle's high. That would be typically the shaded area here. So don't be confused. I'm not drawing it to here to make up the 60-minute fair value gap, which is in the form of a buy side imbalance, sell side inefficiency. So only buy side was offered here, sell side was offered to it there, and then quickly after hitting the balanced price range, consequent encroachment, price immediately erupted to the upside.
So something I noticed right here is obviously we have these PD arrays that were formed kind of in this area, kind of a buy model. And then we generate liquidity. So we come up here, we make this high, we come up, we miss the high, making another one, we make another one. And then not until we come down and we sweep this entire range right here, that's when we're showing like a willingness to want to come back up and trade through that.
Working up into this fair value in the form of a city, sell sign of bounce, buy sign of efficiency. Notice how many times it hits that daily bearish order block here. It's worked the level here, here, and here. And that mean threshold of the weekly bearish order block here at 104.54. That also has a small little bit of a inefficiency still remaining here. So we got as high as that candle here, but between this candle's high, that candle's low, there's a small little gap in there. So if you look at the high and the low and the higher high here, this down close candle, extend that through, that's a ICT bearish breaker. So you can see it being respected here, here, and even here. So it would be much more meaningful to me if we were to break that low here. Otherwise, I'm going to stick with the likelihood that dollar index will either consolidate or go higher. Either one, I could care less. Right now, I'm still neutral, and I'll explain more about that as we go. Here's Eurodollar. This is its weekly chart.
So something to consider is because we have this daily order block, just negating price lower. Once we come above that, above all this price, we're likely to just extend out after that, right? If we have a PD array that's holding us back and we're able to invert it, we're able to deny it, it becomes negligent, then we would see that follow through, that expansion.
Runs, they can still deliver and go below here, but high resistance liquidity runs are very frustrating sometimes for individuals that don't know how to anticipate them or don't know what they are. So I teach you in my concepts to identify what a high resistance liquidity run is, so that way you can understand the distinctions between that and a low resistance liquidity run. Low resistance liquidity runs are high probability and they are immediate gratification. They just immediately run to your objectives. It's very fun to trade them. It's almost immediate feedback once you get into the trade. Whereas a high resistance liquidity run is a trade that's met with a lot of resistance in getting to where your objective may be. Now, because I'm calling it a high resistance or low resistance doesn't mean that it's resistance in the sense of support or resistance from the perspective of a retail theory. It's resistance in the form that it's very hard for it to be one-way delivery. So it's going to be a lot of consolidation, move a little bit, come back, retrace much more than you're probably comfortable, and then consolidate more, and then go a little bit further in the direction you were hoping for. That's high resistance. So if a new trader or a break-even trader, someone that makes a little bit of money then loses it, when they are met with those kinds of conditions in the marketplace, it tends to create very sporadic emotional responses in their psyche. They become agitated.
Kind of wanted to show that low resistance and high resistance. Let me go on to NASDAQ. So I would say yesterday's price action would be considered low resistance. You could usually tell from the 1 minute, but yeah, we had all this buy side liquidity up here. You could just see us displacing, just creating fair value gaps, displacing, complete respect of these fair value gaps. Whereas obviously like low resistance would be like choppier conditions right here. But one of the most telling signs of this will always be like what's the draw on liquidity? What draw do we have left to target? And yesterday it was these highs. It was London highs. Yeah, you can see they're perfectly stacked right here. Today it would have been all these lows that we had stacked up for a while. We finally traded down below them.
They will many times get stopped out because they want to move their stop loss too aggressively too soon. From here, you can see how we've hit that bearish order block I mentioned the last time we spoke. Hit it. Now we're just consolidating inside of that gap right there. Now look at all the back and forth here. Up, down, up, down. So it's being met with that in the form of high resistance. Now, can this go higher with the dollar going lower? Absolutely. Can it work its way through this area here and attack the sell side below it? Absolutely. But because it's not one-sided, because it's not so heavy-handed, or because I can justify both sides of the marketplace right now, it's a neutral position for me.
So I know like a few people just got in here, but he was looking at dollar basically is two-sided. He was saying we could either trade lower or trade higher. So regardless of whatever euro looks like, we're always going to be focused on whatever a dollar is doing. That's going to determine what everything else does, because dollar is basically US dollar is basically how I would say it. It's more important. I don't mean that disrespectfully, but it's everything kind of runs on the US dollar. So you have to consider that.
That means I want to only be trading when it's high probability and with low resistance liquidity run signatures. That means that the market is more likely to run quickly right to where I think it's going to go. Either it be a liquidity or a inefficiency. So if I'm looking for lower prices, and if I was being honest with you, gun to my head, I think the dollar is going to go higher. And I think eventually euro dollar will attack these lows in here. Will it meet it before running out this high? That I don't know. But because I don't know that, I'm sitting still with my hands in my pocket, not willing to do anything. But every time I sit down with you, I'm always going to tell you what I believe is likely to occur. If I'm being forced into it was a live stream.
So just as it is important, obviously executing and taking trades, it's just as important or more important to sit on your hands when you know things aren't in your favor, because it's easy to win. Honestly, it's easy to take winning trades, but to hold back those losing trades, to sit on your hands, because most of the time, think about it, most of the time you shouldn't be in a trade. So if you shouldn't be in a trade, then just avoiding those unnecessary losses and being in at the right time is what essentially makes anyone profitable.
Earlier, and I mentioned this area here, how the market ran up, hit buy side, traded into a short-term premium relative to this high, to that low, and then once it hit the buy side and that premium fair value gap in the form of a SIBI, sell side imbalance, buy side inefficiency, it worked lower to attack the sell side here. There was sell side liquidity here, and the market was hanging right around in this area here. And we'll look at that on a 15-minute time frame. But eventually it moved higher to the top end of that daily fair value gap, then went lower, failed to make the lower low here, and then reversed higher to trade into a deeper premium further up in the upper portion of this 60-minute fair value gap in the form of a sell side imbalance, buy side inefficiency. Then back into that daily fair value gap. So now on the 15-minute time frame, here's that hourly fair value gap. It ran up into it here. And notice we were talking about in the live stream, I said, while we were hitting this area here, I said, if it were going to go lower, and it would be a high probability scenario for it to go lower, I would prefer to see price stay below this level here. If it was to go higher, I'm not interested in going lower. Basically, consequent encroachment from the fair value gap high and the fair value gap low, and that shaded area here is the daily fair value gap. If we were to meet consequent encroachment and then break down and create another fair value gap that would be viewed as a premium array, then I would look for that low and that larger sell side liquidity pool to be taken. But because if it were to go higher, remember, I would prefer it to stay around consequent encroachment, not go up to the high.
So basically, he wants to see that respect of that fair value gap, which would be the CE, which you can see it respects it pretty well right here. But then it comes up and it kind of fills it in right here. So he's saying if we're likely to basically roll with momentum, which would be like coming down, probably disrespecting this inversion fair value gap, creating a normal fair value gap and just trading lower. Whereas if we're coming up here, we're less likely to see that run occur. Something else I'd like to mention is you could see when London opens right here. This is probably 2 right here. So we see like a bullish run right here, but then at London close, we see that reversal. That's pretty common. So if you're trading London, sometimes it's a good idea if you have like a major right here. This would be a major buy side. That would be a good idea to take most of your position off, because we're likely to see that retracement going into New York.
Because if it does that, all that means to me is it goes back down lower, it's likely to not go below that low. Go back and listen to the live stream where I was talking about it in here. The reason why I'm not interested in once it gets up to here, even though it did drop, notice it dropped handsomely from this high of the fair value gap, but didn't take out the sell side. Because we are in that neutral zone for me as a trader where I don't want to take a trade. If we're to tape read or study it, ideally we want to see consequent encroachment, which is the halfway point. All right, ES, E-mini S&P June contract. We'll be rolling over into the September contract here shortly. But for now, we're just looking at the June contract. So this gap in here is what I said we would draw up into. We obviously did that. And we're looking at the weekly chart, and the candlestick is represented as such here. So we hit the high of that gap, and then we've been banging around inside that, which is typical. When price runs to a higher time frame target, lower time frame candlesticks and charts will move into a consolidation profile. Consolidation profile after multiple markets have met their objectives. As I mentioned with the dollar index, it's traded up into our premium objectives. Euros traded down into our discount objectives, and ES has traded into its premium objectives. So when that occurs, the market will tend to do what? Consolidate, which is why I'm saying I'm neutral. So you can see how there's a
Yeah, so normally we're trading up into a major level right here, volume void. We're likely to see us have small daily ranges. So normally when we're trading, we're looking for daily expansion. We're less likely to see daily expansion if we're hitting a major buy side, sell side, or inefficiency, where we're likely to just see small, you'll see on the lower time frame, it's small runs, usually consolidated. So that's a time where we want to be patient, not take too many trades. I'm just gonna skip into this to get slower time frame.
drops into a fair value gap, rallies up and into our gap. So in the upper portion of that volume imbalance on the weekly chart, which is that white shaded area, and that specific area where there was no trading, it's worked its way up in there. And now look how it's just hanging around in there. See that? Interesting, isn't it? Watch what happens when we drop into a lower time frame. Here's the hourly chart. This blue line is the high of that weekly gap.
That is terrible price action if I've ever seen it. Where are you gonna take a trade? I guess like right here, if you're trading that external liquidity, because you can see that that's the buy side. But that is terrible. Like 3 days of trading, I would not be in here at all.
This blue line is the low of that weekly gap. The white shaded area is the volume imbalance. I'm drawing your attention to this wick right here in its midpoint, which is consequent encroachment. So this is a discount array because it's below market price. Let's play devil's advocate for a moment, and let's assume for the sake of discussion that the market does in fact want to go higher. It could trade down into this area here and then run for buy side. Notice how they left clean highs here? So that looks like perfect textbook resistance. I don't like that. I never like that. Smooth edges like to be made jagged. Okay, I have an expression, I say it many times, and I think that this will be disrupted. Now, how and when it will occur, we have to watch and see what price does at each kill zone, okay, or specific times of the day where we like to trade. So I want to see, do we respect price at this discount, consequent encroachment of that wick? If it runs through it, there is another wick right there. So this midpoint of that.
So notice there's like no fair value gaps in here. So that's what we would be looking at on a chart. We're going to be looking at wicks and how well is price going to respect that, because if we take this sell side, we respect that, we still see a willingness to create a market structure shift higher, that would give us good reason to see us actually trade up into these stacked highs he's talking about, these buy side.
That one, you want to draw that out in time too. It's also basically these highs. Now, what I don't like about that is I don't like it going back down to these relative equal highs, because that's treated as what? Resistance, turn, potential support, right? I don't like that. So take us back into that higher time frame daily chart. Remember what I said about 4240? 4240 is in that volume imbalance on the daily chart. So it could trade down into and below these highs here if it really wants to be aggressive. Trade down through that all the way to the low of that volume imbalance on the weekly chart, which would take us into this area right here. Right there. Okay, so just be mindful. I don't have like an affinity for like these levels here, draw there, and this is the daily fair value gap inside of that. All right, here's the 15-minute time frame on ES today. High. Look how it stopped right at the high of that volume imbalance. Folks, that's perfect. It goes right to the tick. Not in your textbooks, just in the book of ICT. Breaks lower, trades to the low of the gap. Now, this line and that line are the gap levels on our weekly chart for ES. The white shaded area is the volume imbalance. This is that wick discount consequent encroachment level that I just showed you before we drop down and go back up. That's this one here. Okay, so wick discount consequent encroachment there. I can already hear some of the newer students. This is really complicated. Everything's complicated when you first start. So I'm thinking that we could draw down into that, and how we trade to it and if through it, all the factors I just gave you for the other hourly chart, they are to be weighed out. That's why I'm waiting to see. I don't have a very clear definitive, here's my next setup. I'm watching those levels to see how it forms market structure around them. So I'm not trying to guess. I'm not trying to be predictive yet. Okay, so I'm sitting neutral. We're not reacting to price. We never react to price, but we're sitting still waiting for more information so that way we can predict the next outcome right now.
Yeah, because if we're trading right here, we're probably gonna trade lower just because of how close we are to these liquidity. But like if we were to look for a long, you have no info to further like follow along with that confirmation. we're gonna have to wait for all of this development, which would be us trading down into that wick discount and seeing, does time align, do all of our factors in terms of dollar, NASDAQ, all of our confluences, are they aligning for us to go long? If not, then why are we going to go long? Let's look for a short. So
now it's uncertain, but I do have the opinion, if the gun is in my head, where I think it's going to go. I think it's going to go lower first to go higher later. And the 5-minute chart, you can see here we had buy side resting above these highs here in this short-term high. This is your opening range Judas swing, so it rallies up, hits the high, that weekly gap high, and drops lower. So now there's buy side resting above that. To the left over here is that other relative equal high on Monday that formed. So over
this would be a high resistance liquidity run right here, because we had traded, we're inside of a, I believe it was a daily or a weekly volume imbalance, volume void. So because we're in that, we're more likely to see these kind of like shallow runs, these choppier runs, whereas during greater conditions we would just see like straight candles. There would still be retracements, but not this heavy, really heavy retracements in here.
You can see how you hit it, broke lower, drew back into current new week opening gap, came back up to it, new week opening gap, and then rejected, traded down to the weekly gap low, and then consolidated around it. Breaks lower, shift in market structure that's bearish. Small little imbalance here. This right here, that move right there, that is the 2022 ICT mentorship model. So buy side taken into a premium, shift in market structure, fair value gap, trades up into it, there's your sell. Go short. What do you aim for? Relative equal lows and liquidity.
So what do you do if you miss that trade for whatever reason? Maybe you don't like how it comes up and closes into that fair value gap. You'd wait for another displacement leg, which would be exactly what he shows right here. You could even go and take another trade right here, or you could add to your position. I'd say the perfect mix of both right here would be to enter off of this and then add a half position right here, because we, especially this low and this low, we're generating more liquidity, so we're likely to just keep trading down. So this fair value gap would be your pyramid entry, which is how I like to trade, just scaling into a large position.
If you want to be overzealous, you can aim for the weekly gap low. I personally wouldn't have, but for the sake of argument, you could have. We're going to take a look at that same price swing. All of this is the initial run up. This is a Judas swing, okay, in the first 30 minutes of trading. So at 9:30 opening bell, we see the price run higher, stops dead in its tracks at the weekly gap high, the gap high that I told you about weeks ago. Having that level on your chart and then anticipating price reacting there. Swing low, it breaks lower, and that gives us this small little gap right there. This gap right there is simply a fair value gap. It's a common gap. They can be traded though with the context that I've already taught you. 2022 model, buy side, higher time frame level, takes buy side. Does it go after the short-term low? Yes, it does. Did it leave a gap? Yes, it did. Can it trade up into it? It does. Go short, stop above this candle's high right there. If you're really scared and you don't want to take a larger risk, put your stop right above here and trade with less leverage. The market breaks lower, and we have this gap right here. This is a fair value gap in the form of a SIBI, just like this is, but this is a breakaway gap. What is it doing? It's breaking away from this important higher time frame high.
Let me answer the questions real quick. You guys were asking me. When should we not take trades because of low probability? It's been pretty volatile, so I kind of want to take a look. Yeah, so probably like right here, Friday, we did not have red folder on this day. Actually, we did. We had Powell speaking. But we wouldn't, like, you could see how we're just kind of grinding up right here, just slowly. That's kind of signs of a higher resistance liquidity run. And once we trade up here, like, okay, well, you probably don't want to get long if we have all of this sell side. But then it's also difficult to find a short in here. There's definitely a short opportunity, like right here. But this is a more difficult day where at the start of the day, you're going to need to be really patient until we get more development. Even that one got ran. So if you would have gone short right there, you would have gone ran. Let's try this one. Yeah, that one worked out. But on this day, you would have had to have a 40-point stop, which is pretty much double the normal stop. You'd have to lower your size overall. But this is kind of a day you'd want to avoid, just because it's more volatile. You could know based on news. So Monday, probably wanted to avoid this week. Tuesday was all right. Today, there was trades, but it was much more difficult than a normal day. So let me get in here. Right, if we're waiting for silver bullet, which is 10 a.m. right here, then we would have had to wait for all of this development, had to sit on your hands during this time. There's no fair value gaps, there's no reason to enter. But then we do create this, which is an inversion fair value gap with a normal fair value gap. That would be a BPR, balanced price range. So all of this is balanced. So we could go ahead, take a trade, stop right there, and then we could erode it down. But if you're an impatient trader or you don't know what you're doing, you're gonna get stopped all day in here, all day. You really have to learn how to be patient. When was the expansion this week? Today. This was a huge expansion right here. Huge. So based on what I just talked about, you can know low resistance to high resistance based on news, based on how much we've already expanded. Because we already expanded prior to our silver bullet, it's going to be a little choppier. You might still get that run, but it's going to be overall harder to find that run and know when to enter. Why do we set stop loss just above the last candle? So if you want to reduce your overall risk, we could do this. So say we want to enter right here and we don't think price is going to trade up higher. We think it's just going to enter the tip of the fair value gap. We would put it right there. That's where your stop would be. That's not a bad stop. When you have a larger fair value gap like that, I do like to put it right there. For me personally, I like to add a little bit of extra meat on that stop loss. But yeah, I probably wouldn't put it at this very high. That's, in my opinion, that's a little too much. I think this is perfect. I feel like price should respect that. This is a unicorn right here. You have breaker, fair value gap, you have an inversion fair value gap, you have an order block. So this is a really good area right here. So I would put my stop right there. Shouldn't go farther than that. So do we always put it? Yeah, I would put it at so we have a 3 candle pattern, right, with a fair value gap. You have this candle and then this candle. I would say the candle that makes the fair value gap, which is the middle one, I would put it right above that, like there. Let me see if there's any more examples in here. Right here. If you're entering on that fair value gap, put it right there. And TP right there. Yeah, so days we're gonna have low resistance liquidity run. I know today, like, we had a large expansion, but that's just because normally we won't have these large expansions on days without news because we're on a Wednesday today. No news. But we do have Nvidia earnings. There's a lot of fear in the market, so we're just moving a lot. Every day we've been moving a lot. But on a normal week, we're gonna want to focus on just red folder. So these GDP and unemployment claims, core PCE, all this stuff right here. Like Tuesday was great trading that day. So we want to focus on those days.
Inside the model of the 2022 ICT mentorship model that I taught you, and it's moving aggressive. So we have two times there's a shift in market structure that's bearish. This is a breakaway gap. Breakaway gaps must have some context as to why price should see. For instance, this is a bearish breakaway gap. It's breaking away from a level that we would already anticipate being some measure of short.
So we're almost done, so I'm just gonna kind of like skip through here, explain what he's saying. So this initial fair value gap, it's not super significant. Like, we could take it as a trade, but as price is developing, we're not gonna look at it as, this is gonna send us all the way lower. Like, we have to have more development. So once we create that fair value gap, we trade lower. We have a second displacement leg, right? This is negating all of this IFEG, this order block. We're breaking away from that area, which is essentially balanced. We're going to consider this, all of this up and down movement right here, this is balanced. Now, if we have this large fair value gap, we're creating that breakaway. We're likely to see us have a very large move after that. We're breaking away from this balanced price area. If we're going to trade away from that, what do we have left to trade to? Well, we have these lows, and then we have this weekly gap. That's the only thing we could target. So that's what we're going to be looking at. Let me see. Measuring gap. Usually when we have like a very large gap, we could use a tool. Let me see if I can find one in here. Let's say this is a measuring gap right here. We delete this. Using our fib from here to here. Okay, well, we went way farther than that, but I would use that as our measuring gap right here. Just a very large gap, price respected, and we could kind of measure out how far it could go, how far likely price is willing to expand. So it went as far as nearly -8. It's a normal SIBI. I'd say this one's more significant because of how much we moved right here, how large this displacement was through this low. Whereas this one, it's kind of like, all right, we're getting kind of close to our target. We probably can't measure anything from there. Yeah, so I'm not really going to look too deep into that. Is a weekly gap a weekly fair value gap? Weekly gap high. No, he was talking about a volume imbalance. So kind of like this. This is a daily volume imbalance, but you can see kind of how price trades inside of it. We're kind of just like, you can see by the tick right here, kind of respecting it right here, and then once we're kind of filling it in, you see that respect right there. Once we trade down into it, or down below it, we return to that midpoint, and then clear respect of that midpoint of the daily volume imbalance. Yeah, so that's that. Other than that, I'm gonna stop the stream.